Today I want to analyze Tesla, one of the major electric vehicle companies in the world. We can see here around 81% of their revenue comes from the automotive sales, around 6% from the energy generation and storage. So this company is mostly a car company. Of course, nowadays cars have more and more technology as well. If we take a look at the stock price, we can see in the last 3 months, we are down around 53%. So we are big down, and we're going to take a look at the financials to find out if this company is undervalued right now. The first one we can recognize is a huge market capitalization of 714 billion US dollar. So this makes this company the biggest car maker in the world by the market capitalization. And also, if we take the other 7 biggest car companies in the world, we wouldn't reach the market capitalization of Tesla right now. So I think this company is already priced like a technology company. The first thing we're looking for is revenue growth in the last 5 years, because we want to invest in a growing business and not a declining business. So we can see here in 2020, the revenue was around 31 billion US dollar. So this was a 28% increase. Then we had a 70% increase in 2021. Then we had the 51% increase in 2022, then the 18% increase in 2023, and then around 1% increase in 2024. So we had the incredible growth, especially in 2021 and 2022, but now we can already see it's slowing down. So overall it's a check here, but we can see the revenue growth gets more difficult right now. The next thing we're looking for is free cash flow growth in the last 5 years. So free cash flow is especially important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and to pay back the debt. So we want to see that grow in the next 5 years, and we can see here the free cash flow was around 3 billion US dollar in 2020. Then it was around 5 billion in 2021. We had a strong growth. Then around 7.5 billion in 2022. And then we had the decline again in 2023, around 42% decline, and then around 18% decline in 2024. So this is something we don't really like to see. We want to see that the free cash flow is growing in the last 5 years. So overall, it's still a check here, but now we have in 2 years in a row already the decline. This is something we don't like. Now, if we take a look at the operating cash flow, we can see we had around 10% decline in 2023, but we comparing that to the free cash flow decline of 42%, it's way smaller. And the reason for that is that we investing huge in capital expenditures. This means this company investing in new factories and other projects as well. So this number increasing in 2024, it was the highest, around 11 billion. And then we can see here we had the operating cash flow growth in 2024 around 12%. So this is not a bad sign. I think this company investing huge in the future right now. The next thing we're looking for is free cash flow yield over 4%. So this can also tell us about the valuation of this company. If it's under 4%, it can indicate that this company is overvalued. So what we're going to do now, we're going to take the free cash flow in 2024. So this is around 3.58 billion. Then we're going to divide it with the current market cap of 714 billion. So then we're going to get the free cash flow yield. So the number we get is around 0.5%. So this is not a good number. We can see here it's definitely under the 4%, and it can indicate that this company is overvalued. But I also think we should ask them in the future that they probably can increase the free cash flow margin. So right now it's around 3.6% free cash flow margin. If we can think that they come to the 8% or 9% again, then the free cash flow would look way different. So let's assume that this company can reach the 9% again in the free cash flow margin. So what we're going to do now is we're going to take the revenue and then we're going to multiply it with the 9%. So then we're going to get the free cash flow margin. So the revenue was around 97 billion. If we multiply this with the free cash flow margin, we would get a free cash flow of around 8.73 billion. So this is the assumption that they can get the free cash flow margin to 9% again. Then we're going to divide it again with a market cap of 714 billion. And now we would get the free cash flow yield around 1.22%. So even with the assumption that they can make the free cash flow margin higher in the future, this company looks incredibly overvalued. 1.22% is really not good. So overall, it's not a check here for the free cash flow yield. The next thing we're looking for is debt to free cash flow ratio under 5. So this means the company can pay back the debt with a free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So what we're going to do now is we're going to take the long-term debt. So the long-term debt is around 5.54 billion. Then we're going to add the short-term debt as well. So the short-term debt is around 2.34 billion. Then we're gonna divide it with the current free cash flow, and we're gonna use the assumption of the 9% free cash flow margin. So we're gonna use the 8.73 billion as a free cash flow. So the number we get, I will calculate it. So the number we get is around 0.9. So this means in close to 1 year, we can pay back the debt with the free cash flow if we take the assumption that we have a 9% free cash flow margin. So overall, it's a check here. It's a good number, and we like to see that. We can also take a look at the cash on hand, so how much money this company has in the bank. And we can see here, this is incredible. They have around 36 billion US dollar in the bank. So this is a big amount, and they can use this to invest in the future into businesses. So overall, the balance sheet is looking very good. The next thing we're looking for is enterprise value to free cash flow ratio under 25. So this can also tell us about the valuation of this company. If it's over 25, it can indicate the overvaluation. But of course, we also need to assume that some companies have a higher growth than other companies. So what we're going to do now is we're going to take the market cap. This is around 714. Then we're going to add the debt. So the debt is around 5.54 plus 2.34. So around 7.88. And then we're going to take minus the cash. So the cash we have is around 36 billion. So then we're going to get the enterprise valuation. So the number we get is around 685 billion. So this is the enterprise valuation. Then we're going to divide it with the free cash flow. So we're going to take this assumption again, the 8.73 billion. So the number we get is around 78. So this again is not a good number. It can indicate that this company is incredibly overvalued. So it should be, or we would like to see it under 25. This could indicate an undervaluation. So it's not a check here. And I think currently this company looks overvalued. If they cannot make in the future more free cash flow and growing the free cash flow even more. So the next thing we're looking for would be shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So what we can see here is the shares outstanding increase. So this is not a surprise actually, because this company is still looking for growth in the future and they're investing huge money in the business. So overall, I'm not expecting them to buy back their own shares. So it's not a check here. I would like to give my conclusion about this company. So let's start with the positives. So they had a strong revenue growth in the last 5 years, especially in 2021 and in 2022. But we also need to mention that now the revenue growth is slowing down. So we don't really like to see that. We have a good balance sheet with a good amount of cash on hand, around 36 billion, and a low amount of debt. So we can repay the debt with the current free cash flow in about 1 year. So this is a good number. The negative would be we have a free cash flow yield around 1.22%. So this is with the assumption of a free cash flow margin around 9%. So overall, from the free cash flow yield, this company looks overvalued. And also, if we take a look at the enterprise to free cash flow ratio around 78, this company again looks overvalued right now, just from the financial perspective. If we take a look at the stock price, we can see we are down significantly in the last 3 months. But overall, from the financial, this company still looks overvalued. So even this company had a reduction in the stock price right now, but we can see overall in the last 5 years, we're still up 500%. So I think this company can still be overvalued right now.